Are you looking to diversify your investments for optimal returns? The world of investing can be a complex and daunting one, but the principle of diversification serves as a guiding light. Diversification, in its essence, is about spreading your investments across different asset classes, sectors, and geographical locations. It's not about putting all your eggs in one basket, but rather, it's about spreading them out into many baskets. Imagine for a moment you're an apple farmer. Now, if you have one apple tree and that tree gets sick, you're out of luck. No apples for you this season. But what if you have 100 apple trees? If one gets sick, it's not great, but you still have 99 healthy trees bearing fruit. That's diversification in a nutshell. In the realm of investing, diversification plays a similar role. If you put all your money into one company's stock and that company tanks, your investment takes a nosedive. But, if you spread your investments across a range of companies, sectors, and even countries, the risk is spread out. If one investment performs poorly, others may perform well and offset the loss. But diversification isn't just about reducing risk, it's also about potential returns. Different investments can perform well at different times. By having a diversified portfolio, you're more likely to have a piece of the action when a particular market or sector is doing well. Take the tech boom of the late 90s, for instance. Those invested solely in technology stocks made a fortune, but when the bubble burst, those same investors suffered massive losses. However, those with a diversified portfolio, spreading their investments across a range of sectors, were better equipped to weather the storm. Diversification also provides an opportunity to explore emerging markets and sectors. Technologies like artificial intelligence and renewable energy are rapidly growing sectors that offer exciting opportunities for investors. Diversification is a key strategy for any investor looking to optimize their portfolio. By spreading your investments, you can reduce risk, increase potential returns, and make your portfolio more resilient in the face of market volatility. So the next time you're considering an investment, remember the apple farmer and spread those seeds far and wide. Now, have you ever thought about your risk tolerance? Risk tolerance is not a concept that should be taken lightly. It's your personal comfort level with the potential for loss. In the world of investments, it's often said that higher potential rewards come with a higher risk. But how much risk are you willing to accept in pursuit of those rewards? Understanding your risk tolerance can significantly guide your investment decisions. If you're someone who can't sleep at night knowing your investments might take a downturn, you might be more risk-averse. On the other hand, if you're comfortable with the idea that you might lose some money in the short term for potential long-term gains, you might have a higher risk tolerance. These are not just theoretical concepts, they should be at the forefront of your investment strategy. Your risk tolerance will help shape your portfolio, guiding which assets you choose to invest in. Knowing your risk tolerance is a critical step in the diversification process. Are you aware of the different types of investments available to you? It's like walking into a grand buffet. You have many options, each with its own flavor and benefits. Let's dive into this buffet of financial delicacies, shall we? Think of stocks as the main course. When you buy stocks, you're buying a piece of a company. The performance of the company dictates the performance of your investment. Stocks can be volatile, but they also present an opportunity for high returns. It's like a perfectly cooked steak, risky but potentially very rewarding. Bonds, on the other hand, are the comforting soup. When you purchase bonds, you're essentially lending money to an entity, like a corporation or government. In return, you receive interest payments over a specified period of time. Bonds are generally considered safer than stocks, offering steady, predictable returns. A warm, comforting bowl of soup indeed. Next on the buffet are mutual funds, the mixed salad of investments. These are professionally managed investment funds that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. So, you get a bit of everything in one serving. Then there's real estate, the hearty, filling bread of your investment meal. Investing in real estate involves purchasing properties for rental income or capital appreciation. This tangible asset can provide a steady income stream and act as a hedge against inflation. Lastly, we have alternative investments like commodities, hedge funds, or private equity. These are like the exotic desserts, not for everyone, but can add a unique flavor to your investment portfolio. They can be complex and often require a higher minimum investment, but they can also provide significant returns and further diversification. As you can see, each type of investment has its own characteristics, benefits, and risks. And just like at a buffet, A well-rounded investment plate includes a mix of different dishes. Not too much of one thing, but a bit of everything. There's a world of investment options out there. The key is to select the right mix for you. Ready to create a diversified portfolio? Let's dive straight in. The creation of a diversified portfolio takes a thoughtful approach, with a keen understanding of your risk tolerance and investment goals. First and foremost, you need to consider your risk tolerance. Are you a conservative investor who prefers steady growth over time? Or perhaps you're more of a risk taker, ready to jump on high-reward opportunities despite the potential for loss? Once you've got a good handle on your risk tolerance, you can start picking out investments that suit your style. Next, think about your investment goals. Are you investing for retirement, a down payment on a house, or maybe your child's education? Your goals will heavily influence the type of investments you should be considering. Now let's talk about the actual process of creating a diversified portfolio. It's all about spreading your investments across a variety of assets. These could include stocks, bonds, real estate, commodities, and even alternative investments like cryptocurrencies. The key is not putting all your eggs in one basket. Spread your investments across different sectors and geographic regions. This way, if one investment doesn't perform well, others in your portfolio might still be thriving. But how do you decide what to invest in? Well, it all comes down to research. Research the performance of different sectors, study market trends, and keep a keen eye on global economic indicators. And remember, diversification isn't just about having a variety of investments. It's about having investments that don't move in the same direction at the same time. The goal is to have some investments rise when others fall, helping to smooth out the overall performance of your portfolio. Lastly, keep in mind that creating a diversified portfolio isn't a one-time task. It's an ongoing process that requires regular review and adjustment. As your goals change or as the market shifts, you'll need to tweak your portfolio to keep it aligned with your objectives. A diversified portfolio is not a one-size-fits-all. It's tailored to your unique investment goals and risk tolerance. Remember, the goal is not to eliminate risk, but to manage it in a way that aligns with your investment strategy and long-term goals. So, you've created a diversified portfolio. What's next? You've taken the first crucial steps towards becoming a savvy investor. But remember, a successful portfolio isn't a set-it-and-forget-it kind of deal. It requires regular maintenance to keep it aligned with your financial goals and risk tolerance. Think of your portfolio as a garden. You've planted various types of seeds, representing different types of investments. Some will grow rapidly, some slowly, and some may not sprout at all. To keep your garden healthy and balanced, you need to tend to it regularly. Similarly, your portfolio needs to be reviewed and adjusted periodically. Why is this necessary? Well, over time, market conditions can affect your portfolio balance. For instance, if your stocks perform exceptionally well while your bonds lag, your portfolio may become heavily weighted towards stocks. This could expose you to higher risk than you initially intended. That's where rebalancing comes into play. This process involves selling high-performing assets and buying underperforming ones to restore your portfolio's original allocation. It may sound counterintuitive to sell your winners, but remember, rebalancing is about risk management and ensuring your investments align with your long-term objectives. Now, how often should you review and rebalance your portfolio? There's no one-size-fits-all answer. It depends on various factors like your investment strategy, market volatility, and personal circumstances. However, a good rule of thumb is to review your portfolio at least once a year, and whenever there are significant changes in your life or the market. Keep in mind, maintaining your portfolio isn't just about rebalancing. It's also about reassessing your risk tolerance and financial goals. As you journey through life, your goals and risk tolerance may change. Maybe you're planning to buy a house, start a business, or retire. These life events may require you to adjust your portfolio accordingly. Maintaining your portfolio is just as important as creating it. Regular reviews ensure your investments stay aligned with your goals. Your portfolio is a living, breathing entity that evolves with you. Nurture it, and it will grow along with your financial dreams. We've covered a lot today, haven't we? We've mastered the importance of diversification, delved into understanding our individual risk tolerances, and identified the different types of investments that could be in your portfolio. We've also walked through creating a diversified portfolio and how to maintain it for optimal returns. Now, it's your turn to take action. Don't let your hard-earned money sit idle. Start by understanding your risk tolerance. Then explore the different investment options available to you. Create a diversified portfolio that aligns with your risk tolerance and financial goals. Don't forget to periodically review and rebalance your portfolio to ensure it's still meeting your needs. Investing can seem daunting, but with a diversified portfolio, you can spread your risk and potentially increase your returns. So go ahead, take that first step towards a more secure financial future. Remember to like, share, and subscribe for more investment tips. And always remember, diversification is your friend in the investment world. The information provided in this video or communication is for informational and educational purposes only. It is not intended as and should not be considered financial, investment, legal, or tax advice. The content is based on general principles and may not be applicable to your specific financial situation or needs. Always consult with a qualified financial advisor, accountant, attorney, or other professional before making any financial decisions or taking any actions related to your finances. Any investments or financial decisions you make are solely your responsibility. Past performance is not indicative of future results, and there are no guarantees of any specific outcomes or returns. While every effort has been made to ensure the accuracy and completeness of the information provided, we do not warrant or guarantee its accuracy, reliability, or suitability for your individual circumstances. We do not endorse or promote any specific investment products, services, or strategies mentioned in this video or communication. Any references to such products, services, or strategies are for illustrative purposes only and do not constitute a recommendation or endorsement. You should conduct your own research and due diligence before making any financial decisions. In summary, this video or communication is not financial advice, and you should not rely on it as such. It is essential to seek professional advice tailored to your specific financial situation and goals before making any financial decisions or taking any actions.